Part 1, Basics, Starting a Business, Financial Statements, and Common Stock. Starting a Business. The book begins with the fictional story of Mr. Jones starting a mousetrap company, JMC. His trusted friend and accountant, Mr. Greenshades, agrees to help him with the process. He explains that JMC is currently a sole proprietorship, which simply means Mr. Jones owns the whole company. He advises Jones to keep accounting records in the same manner as most other companies, urging Jones to possess the two primary financial statements, a balance sheet and an income statement. The balance sheet reflects the financial condition of the company at a given point in time and has three major categories. 1. Assets, anything of value that the company owns or has claim to. 2. Liabilities, debts the company owes. 3. Owner's equity, the combination of the amount of money put into the company by the owners and any retained earnings. As the name implies, the balance sheet must completely balance out, with the sum of the liabilities and owner's equity equaling the assets. The income statement shows the revenue, sales, the company has made, the expenses that have been incurred to make those sales, and the profit or loss that results over a specific period of time. The income statement is commonly referred to as a profit and loss or P&L statement. Ownership and stock. Business is going well and Jones wants to expand his company by buying some land and building a small factory. At this point, JMC doesn't have much cash or many assets. This means a bank is unlikely to loan JMC the money he needs, simply because it is too risky. Since Jones also does not want to put any more of his own money into the company, Greenshade suggests that he raise equity capital. He explains that equity capital is money that is permanently put into a company in exchange for a portion of ownership. Unlike bank loans or bonds, this money never has to be repaid. 4 of Jones' friends have faith in him and agree to contribute the money needed for the new factory in exchange for 40% of the company, 10% each. As equity investors, they are willing to risk their capital because they know that if JMC is profitable, they can recoup their investment and more through dividend payments. Dividends are one way companies share a percentage of earnings with investors. Furthermore, these investors hope the value of their share in the company will appreciate over time and can be sold for much more than they contributed. Greenshades explains that stock can be used to reflect ownership of a company. They decide to create 100 shares of stock, of which Jones will retain 60 shares, and each investor will receive 10 shares. The number of shares is purely arbitrary, it could have been 10 or 1,000 as long as the percentages were the same. Additionally, since there are now 5 investors, JMC is no longer a sole proprietorship and needs to be converted to either a corporation or a partnership. He explains that a corporation is a legal entity, separate from the owners of the company. The primary advantage of a corporation is the limited liability of the owners, which means they cannot be held personally responsible for the debt of the company. This differs from the liability agreements under both sole proprietorship and partnerships, which require owners to use their personal funds to settle any debt the company fails to pay. They agree to incorporate and change the name to JMC Inc. Greenshades explains they are now all shareholders and therefore entitled to certain rights. These include receiving the company's annual report, attending stockholders' meetings, and voting on issues raised at the stockholders' meetings. These rights are the same for anyone owning stock in larger corporations, such as Apple or Disney, except that these companies have millions of shares. And no one person typically owns more than 1–2%, while many own much and no one person typically owns more than 1–2%, while many own much less. These larger corporations also have a board of directors, who are elected by stockholders and represent their interests. Ratios investors watch. In order to see how well a company is doing, investors often look to their annual report, where information is released about the company's business outlook and finances. While these reports can appear very intimidating, they are one of the main sources of information for investors. The authors state that these ratios can be broken down into 5 groups. 1. Stock evaluation, describe what value you are getting at a certain stock price. 2. Profitability, measures of management effectiveness. 3. Debt and interest, quantify the level of debt a company has to determine its relative risk and ability to raise more money if needed. 4. Liquidity or financial condition, measure of ability to pay off debt in the short term. 5. Efficiency, describe how well the company manages specific assets, like inventory. By comparing these ratios to those of other similar companies, one can better evaluate a company's performance and gain insights into stock movements. Going public, primary and secondary offerings. There are 2 main reasons why a company may want to go public. 1. The company wishes to raise capital and does not want to borrow or have another private offering. This results in the company writing new shares and selling them to investors. 2. Existing stockholders in a private company want to sell stock and raise money for themselves. In either case, the company must register the shares they wish to sell with the Securities and Exchange Commission, SEC, and disclose certain financial information so that prospective investors may evaluate the company. Whenever a company sells new stock, this is referred to as a primary offering. The first time that a company registers shares of stock and sells them to the public is called its initial public offering, IPO. When existing shareholders sell their already outstanding stock, whether to the public or other private investors, it is called a secondary offering. Technically, every transaction made on the New York Stock Exchange or the Nasdaq is a secondary offering, but they are usually just called trades. Earnings, JMC goes public. JMC Incorporated has been steadily growing and currently has 12 investors and a total of 500 shares of outstanding stock. It is still a private company and Jones wants to raise money to build a second factory in order to continue growth. He explored the possibility of receiving a loan, but the bank said his debt and interest ratios were, again, too risky for them to lend. Greenshade suggests that they take the company public and that Jones should contact an investment bank. Investment banks have nothing to do with banking as we investment bank. Investment banks have nothing to do with banking as we usually refer to it. Instead, they help companies raise money by serving as the bridge between businesses that wish to sell stock or bonds, and members of the public or institutions that wish to buy. Jones contacts Mr. Gaines, who is an investment banker with experience taking similar companies public. Since JMC is planning to launch an IPO, some of the current shareholders decide to sell some of their own shares as a secondary offering along with the primary offering. Gaines tells Jones the price of a stock is related to how well a company has been doing in the past and how well it is expected to do in the future. He believes that given the expected growth rate of the company and the market outlook, the stock should sell at a price to earnings, P/E, ratio between 10x and 12x. This means that if JMC was expected to earn $2 per share this year, new stock should sell between $20 and $24 per share. Gaines also points out that JMC wants to sell its shares at the maximum possible price for two reasons. 1. To maximize value for the selling stockholders. 2. To ensure the company can raise the necessary funds selling as few shares as possible. This ensures the current owners suffer the smallest dilution. Dilution occurs when outstanding shares of a company's stock lose value as a result of the company issuing more shares. It is equivalent to cutting the same pie, earnings, into more pieces, stock. Issuing new stock at the maximum possible P/E ratio results in the smallest amount of dilution. However, if the asked price is too high, people will be reluctant to buy. It is here that we see the two sides of the capitalism coin. On one side are investors who wish to invest their capital, money, where they see the fastest growth. On the other side are the companies that wish to raise capital. The result is, on the other side are the companies that wish to raise capital. The result is that the companies with the most successful products, i.e., what consumers want, have the easiest, cheapest ability to raise money and increase production of these products. Jones agrees to work with Gaines, who charges a small commission for each share sold, and JMC Inc. is taken public. If you enjoy this content and similar content, please consider liking, subscribing and hitting the notification icon. Please also consider seeing some of the affiliate links in the description below, and it really helps out the channel. Thank you. Have a wonderful day.